most traders think the market is speaking clearly to them through candlesticks. A pin bar appears, a doji forms, an engulfing candle flashes, and they believe they've been handed a signal. But what if I told you that most of these signals are not guidance, but traps? You've seen it yourself, haven't you? A perfect setup appears, everything looks textbook, and just as you commit, price moves against you. You wonder, was the pattern wrong? Or was I reading it wrong? Let's start with what you observe. You open a chart and spot a long wick rejection candle. It looks decisive, strong, almost authoritative. Price rejected a level, so naturally, you assume the market will reverse. But have you ever paused and asked, who was actually in control during that candle? Because that's the part most traders skip. A candlestick is not a signal. It is a footprint. And like any footprint, it doesn't tell you the full story. It only tells you where someone has been, not where they're going. So when you treat a single candle as a prediction tool, you're making a decision based on incomplete information. Now, here's where it gets interesting. Why do these fake signals exist in the first place? Because the market is not designed to reward recognition. It's designed to exploit expectation. When a pattern becomes obvious, when everyone sees the same pin bar at the same level, the outcome becomes predictable not for profit, but for manipulation. Liquidity gathers around obvious ideas, and where liquidity gathers, larger players act. Think about it. If most traders place their stops just beyond that, perfect candlestick, what does that create? A pool of orders. And what happens when price moves into that pool? It triggers those stops, providing fuel for the real move, often in the opposite direction. So that beautiful candlestick you trusted becomes the very bait that pulls you in. Have you noticed how often the cleanest setups fail? Not messy ones, not unclear ones, but the ones that look almost too perfect. That's not coincidence. Now let's talk about implication. If candlestick patterns can mislead you, then relying on them blindly puts you in a reactive position. You're no longer interpreting the market. You're responding to what you think it should do. And that's dangerous, because trading is not about being right on patterns. It's about understanding behavior. Price moves because of imbalance. Buyers and sellers interacting, not because a candle looks a certain way. So when you see a strong rejection candle, instead of asking, is this a reversal signal? Ask something deeper. What caused this rejection? And is it meaningful or temporary? Or was it a true shift in control? Or just a brief pause before continuation? That distinction changes everything. Let's make it practical. Next time you see an engulfing candle, don't rush in. Wait. Observe what happens after it. Does price follow through, or does it stall immediately? Because real strength continues. Fake strength hesitates. And hesitation in the market is information. You can also look at context. Where is this candlestick forming? Is it in the middle of nowhere, or at a level where something significant has happened before? A strong pattern in a weak location is still weak. But here's a question most traders don't ask themselves. Am I trading the candle or the story behind it? Because the candle is just the surface. The story is what matters. And the story is written over time, not in a single moment. Now consider this. Why do fake signals feel so convincing? Because they align with what you want to see. You're looking for confirmation. The market gives you something that looks like confirmation, and your mind completes the rest of the narrative. That's psychology at work. The danger isn't the candlestick itself, it's your interpretation of it. So how do you avoid these traps? You slow down. You stop treating the market like a series of signals and start treating it like a process. Instead of reacting to a candle, you wait for behavior to develop around it. You look for consistency. You look for follow-through. You look for signs that the market is actually committing, not just reacting. And most importantly, you accept that not every visible opportunity is a real one. That's difficult, isn't it? Because it means letting go of trades that look good, but that restraint is where discipline is built. Now let me ask you something. How often have you entered a trade because it felt right, based on a pattern, only to realize later that the market never truly confirmed your idea? That feeling, that subtle doubt you ignore, That's often the difference between a real setup and a fake one. The market rarely moves with clarity in a single moment. It reveals itself gradually. And if you're patient enough to wait for that clarity, you'll begin to see something most traders miss. The best trades don't come from obvious signals. They come from subtle alignment. Alignment between price behavior, location, and timing. And candlesticks, they're just one piece of that puzzle. So the next time you see a textbook pattern forming, pause for a moment. Ask yourself, if this is so obvious, who is on the other side of this trade? Because every trade has two participants. And if you're entering based on something obvious, chances are you're not the one with the advantage. That's the uncomfortable truth. But it's also where your edge begins. You stop chasing signals. You start reading intent. You stop reacting. You start anticipating. And slowly, almost quietly, your perspective shifts. Because you realize that the market isn't trying to show you the answer. It's testing whether you're thinking deeply enough to question what you see. And once you begin to question it, once you stop taking candlesticks at face value, you start noticing patterns within patterns, behaviors within movements, subtle clues that weren't visible before. And that's where things start to change. Not suddenly, not dramatically, but steadily. Because now, instead of asking, is this a good signal? You begin asking a different question. What is the market trying to make me believe right now, and why? A single candle shows reaction, not true market intention. That distinction is where many traders lose their footing without even realizing it. You look at a strong bullish or bearish candle and assume it represents control, direction, and certainty. But in reality, what you're seeing is only a moment, a snapshot of activity, not the full decision of the market. Think about what creates a candle. It forms from a temporary imbalance between buyers and sellers. For that brief period, one side pushed harder than the other. But does that mean they've taken control of the market? Or does it simply mean they won that one small battle? Most traders never stop to ask that question. A large bullish candle, for example, often feels convincing. It closes near its high, it looks aggressive, and it gives the impression that buyers are in charge. But what if that move was driven by short covering rather than genuine demand? What if sellers were simply exiting positions, creating upward pressure without new buyers stepping in? Now the candle means something entirely different. The same applies to rejection wicks. A long wick suggests price was rejected, and traders interpret that as strength in the opposite direction. But rejection alone doesn't equal reversal. It only shows that, at that moment, price couldn't stay at a certain level. It doesn't tell you what happens next, and that next is where truth lies. Markets don't reveal intention in a single move. They reveal it through continuation, through consistency, through what happens after the initial reaction. If buyers are truly in control, they won't just push price once. They'll defend it, build on it, and continue pressing forward. If that doesn't happen, then that strong candle you trusted was simply noise dressed as signal. You've probably experienced this. You enter a trade based on a powerful candle, expecting follow-through, but instead, price hesitates, stalls, or worse, reverses completely. In that moment, it feels confusing. The signal looked right, so why didn't it work? Because you traded the reaction, not the intention. The market often creates sharp, convincing moves to trigger decisions. These moves invite traders in, creating commitment. But commitment from retail traders often provides liquidity for larger players to execute their own positions. So what looks like strength can actually be a setup. A temporary push designed to create participation. That's why patience becomes critical. Instead of reacting immediately to a candle, you begin to observe what unfolds after it. Does price respect the direction of that move? Does it consolidate and continue? Or does it quickly lose momentum? Momentum fading after a strong candle is not random. It's information. It tells you that the initial move lacked depth, that it wasn't supported by sustained interest. And without sustained interest, there is no real intention, only a brief imbalance that has already been resolved. You start to realize that the first move is often the least reliable. It's the easiest to see, the easiest to react to, and therefore the easiest to exploit. The real edge comes from waiting for confirmation, not in the form of another pattern, but in the form of behavior. Behavior is harder to fake. A single candle can mislead you, but a sequence of actions, higher lows forming, resistance turning into support, steady continuation, those are much more difficult for the market to fabricate without genuine participation behind them. So your focus shifts. You stop asking, what does this candle mean? And start asking, what is the market doing after this candle? That small shift changes how you interpret everything. Because now, instead of being drawn into the immediacy of a move, you're observing its consequences. And consequences reveal truth far more reliably than appearances. The cleaner the setup looks, the more likely it's being watched and used. That's not something most traders want to hear because clarity feels safe. When everything lines up neatly, perfect pattern, a clear level, a strong candle, it gives you confidence. It feels like the market is finally making sense. But ask yourself this, if you can see it that clearly, who else is seeing it? The answer is simple. Everyone. And when everyone sees the same thing, the market doesn't reward that clarity. It responds to it. It adjusts around it. It uses that shared expectation as fuel. A clean setup attracts attention. Attention brings orders. Orders create liquidity. And liquidity is what larger players need to operate. So that perfect support level with a textbook bullish pattern forming on it, it's not just an opportunity. It's a gathering point. Traders place entries there. They place stop losses just below it. They build positions based on the same idea. And in doing so, they create a pocket of predictable behavior. Predictability in markets is rarely rewarded. Instead of moving cleanly in the expected direction, price often pushes just beyond that level. Not randomly, but deliberately. It dips into the area where stops are clustered, triggers them, and in that moment creates the volume needed for the real move to begin. And that's where confusion sets in. You saw the setup. You entered based on logic, but price moved against you first. It feels like a mistake, like something went wrong. But nothing went wrong. You were simply positioned where everyone else was positioned. That's the risk of clarity. A setup that looks too clean often lacks depth. It hasn't developed through struggle or complexity. It's just sitting there, obvious and waiting. And markets rarely reward what is waiting in plain sight. Real opportunities often feel less comfortable. They're not always perfectly shaped. They don't always align with textbook definitions. They require interpretation, not just recognition. That's why experienced traders become cautious when something looks too good. Not because they doubt the setup itself, but because they understand how the market behaves around obvious ideas. They know that clean levels attract stop losses. They know that sharp patterns attract entries. And they know that before the market commits to a direction, it often interacts with that liquidity first. So instead of jumping in immediately, they wait. They observe how price behaves around that clean setup. Does it break slightly below and recover? Does it hesitate? Does it show signs of absorbing orders before moving? Because the behavior around the setup matters more than the setup itself. You start to notice a pattern within this. The market doesn't move cleanly from obvious points. It tests them, it stretches them, it creates doubt, and that process often removes those who acted too early or too confidently. Confidence based on appearance is fragile. When your decision is built on how perfect something looks, it doesn't take much for that confidence to break. A small move against you creates hesitation. A quick spike triggers your stop, and suddenly, what looked certain becomes unclear. But when your decision is based on understanding behavior, you're less dependent on perfection. You're watching how the market responds, not just how it appears. That shift changes your timing. You're no longer the first to enter. You're the one who waits for the market to reveal whether that clean setup is being respected or manipulated. And more often than not, you'll see that initial move doesn't hold. Price dips, spikes, or consolidates in a way that disrupts the obvious trade. That disruption isn't random. It's part of the process of clearing out predictable positions. Once that process is complete, the market often moves with more clarity. Not the artificial clarity of a perfect pattern, but the natural clarity of sustained movement. And that's where patience pays off. Because instead of being caught in the first reaction, you're positioned after the test, after the liquidity has been tapped, after the obvious traders have been shaken out. You begin to realize that the best entries rarely come from the cleanest pictures. They come after the picture has been slightly disturbed, slightly broken, slightly questioned. That discomfort is what filters out the crowd. So the next time you see a setup that looks almost perfect, instead of feeling confident, you become curious. Why is it so clear? Who is being drawn into this? And what happens if the market moves just beyond this point before committing? Stop-loss clusters often sit just beyond perfect signals. That's not a flaw in how traders place stops. It's a natural outcome of how they're taught to think. You're told to protect your risk, to place your stop just beyond a level that shouldn't break. It sounds logical, structured, responsible. But pause for a moment. If that's what you've learned, isn't it likely that thousands of other traders have learned the exact same thing? So where do all those stops end up? In the same place, just beyond the high of a clean resistance rejection, just below the low of a textbook support bounce, just outside the range that looks well defined and respected. These areas become dense pockets of orders, not because traders are careless, but because they are consistent. And consistency in behavior creates predictability. Now think about what a stop-loss actually is. It's not just protection, it's a pending market order waiting to be triggered. When price reaches that level, those stops convert into active orders, adding momentum in the direction they're triggered. That means a cluster of stop-losses is essentially stored energy, and the market has a way of finding that energy. When price approaches a level where many stops are likely placed, it doesn't always turn away cleanly. Instead, it often pushes into that area, triggering those stops in sequence. This creates a surge of activity, a quick expansion in price that looks aggressive and decisive, but that move isn't always genuine strength. Sometimes, it's simply the release of those clustered orders. You've likely seen this happen. Price breaks a level, triggers your stop, and then suddenly reverses back in the original direction. It feels like bad luck, like the market singled you out. But it didn't single you out. You were just positioned where many others were positioned. The level wasn't wrong. The idea wasn't necessarily wrong. But the placement, too obvious, too exposed, made you part of a predictable group, and predictable groups tend to get tested. The challenge here isn't just technical, it's psychological. You want your stop to make sense. You want it to sit at a logical point, somewhere that aligns with the structure you see. But the more logical and obvious that placement is, the more likely it overlaps with everyone else's thinking. So you're caught in a conflict. Place your stop too tight, and normal market noise takes you out. Place it at the perfect level, and you risk being part of a cluster. Either way, if you're not thinking beyond the obvious, you're exposed. This is where awareness changes your approach. Instead of asking, where should my stop go to protect this trade? You begin asking, where are most traders likely placing their stops, and what happens if price reaches that area? That question shifts your perspective. Now you're not just managing risk, you're anticipating behavior. You start to see that those stop clusters often act like magnets. Price gravitates toward them, not randomly, but because they represent opportunity for larger participants to access liquidity. Without liquidity, significant moves struggle to develop. With it, they can unfold more smoothly. So the market often reaches for those areas before deciding its next direction. That's why moves beyond key levels can feel sharp and sudden. They're fueled by triggered stops. But once that fuel is consumed, the market doesn't always continue. It reassesses. And that reassessment is where many traders get caught off guard. They interpret the breakout as confirmation, entering just as the stop-driven move exhausts itself. Meanwhile, those who understand the nature of these clusters are watching for signs of failure, not continuation. Because not every break is meant to hold. Some breaks are simply the process of clearing the path. You begin to notice that the first move beyond a level is often the least reliable. It's reactive, fast, and driven by orders that were already waiting. The more important question is what happens after those orders are filled. Does price continue with strength, or does it stall, hesitate, and drift back? That behavior tells you whether the move had real intention or was just a function of liquidity being released. And once you start seeing stop-loss clusters this way, not as isolated events, but as structural features of the market, you stop taking them personally. You stop assuming the market is unpredictable or unfair. Instead, you recognize that it follows patterns of behavior rooted in how traders think, act, and place their risk. And in that recognition, you begin to adjust, not by abandoning stop losses, but by placing them with greater awareness, by understanding that obvious levels are often tested before respected, by accepting that a level being breached doesn't always mean it's broken. It might simply mean it's being explored for liquidity. Real moves show follow-through. Fake ones stall quickly. That difference is subtle at first, but once you begin to notice it, it changes how you read the market entirely. Most traders focus on the initial move, the breakout, the strong candle, the sudden shift in price. It feels like confirmation. It feels like something important has just happened, but the first move is only the beginning. What matters more is what happens immediately after, when a move is real, when there is genuine participation behind it. It doesn't hesitate. It doesn't struggle to continue. Price pushes, pauses briefly, and then continues in the same direction with consistency. There's a rhythm to it, a sense of commitment. Buyers or sellers are not just reacting, they're pressing their advantage. You can feel that difference when you watch it closely. But when a move is fake, it lacks that continuation. It starts strong, often very convincing, but then something changes. Price stops advancing, it begins to hesitate. Small opposing candles appear. Momentum fades faster than expected, and that hesitation is not random. It's a sign that the initial push didn't have enough support to sustain itself. You've probably seen breakouts that look powerful at first. Price moves beyond a level, closes strongly, and gives the impression that a new trend is beginning. Traders jump in expecting continuation. But then, instead of accelerating, price slows down. It drifts sideways. Sometimes it even pulls back immediately. That's the market revealing something important. The breakout wasn't driven by strong, committed participation. It was driven by a temporary imbalance. Maybe stops were triggered. Maybe short-term traders pushed price briefly. But without sustained interest, that move has no foundation. And without a foundation, it can't continue. This is where patience becomes your edge. Instead of reacting to the initial move, you begin to observe its behavior. You ask yourself, is the market building on this, or is it already losing strength? Because strength in the market is not just about speed, it's about persistence. A real move doesn't need to prove itself with a single large candle. It proves itself by continuing, step by step, without giving back too much ground. It holds its gains. It respects its direction. Fake moves, on the other hand, often give back ground quickly. They struggle to maintain position. What looked like strength turns into indecision, and indecision is information. It tells you that the market is not aligned, that buyers and sellers are still competing without a clear winner. And when there's no clear winner, continuation becomes unlikely. But here's where many traders get caught. They enter on the first sign of movement. They see the breakout, the strong candle, and they act immediately. And by the time they realize the move is stalling, they're already committed. So instead of observing, they're managing risk, and that shift from observer to participant limits your ability to read what's actually happening. If you stay patient, if you allow the market to show its hand more clearly, you begin to notice patterns in behavior. Real moves don't just break levels, they move away from them with confidence. They don't return immediately. They don't hover uncertainly. They create space. That space is important. It shows that one side is in control, at least for the moment. It shows that the move is not just a reaction, but a continuation of intent. When that space doesn't appear, when price lingers near the breakout level, moving back and forth, it's often a sign that the move lacks conviction. And lack of conviction leads to failure more often than continuation. You also start to notice how quickly the market reveals this. It doesn't take long. Within a few candles, sometimes even sooner, you can see whether a move is being supported or not. That means you don't need to predict. You just need to observe. Observation removes pressure. You're no longer trying to catch the exact moment a move begins. You're waiting to see if it deserves your attention in the first place, and that waiting filters out many false opportunities. Because fake moves rely on immediacy. They depend on traders reacting quickly, before the lack of follow-through becomes obvious. Once that hesitation appears, the illusion starts to break, so you begin to shift your focus away from the first move and toward what follows it. You watch how price behaves after the breakout. You watch whether momentum builds or fades. You pay attention to whether the market holds its position or gives it back. And in doing so, you start to see that the initial move is often the least important part of the entire sequence. It's the easiest to see, the easiest to react to, and often the most misleading. The real information comes after, in the continuation, or the absence of it. And as you train yourself to recognize that difference, you begin to avoid trades that once looked appealing. You become less interested in speed and more interested in stability. Because a move that continues gives you something to work with. A move that stalls leaves you exposed. Context outweighs pattern. Location gives meaning to candles. This is where many traders misunderstand what they're actually looking at. They see a pattern form and treat it as a standalone signal, as if its shape alone carries enough weight to justify a decision. But a pattern without context is just a formation. It has no inherent direction, no built-in reliability. The same candlestick pattern can mean completely different things depending on where it appears. A bullish engulfing candle in the middle of a range doesn't carry the same implication as one forming after a prolonged decline at a key level. Visually, they look identical. Structurally, they are not. So the question shifts from, what pattern is this? To, where is this happening, and why does it matter here? Because location is what gives the pattern its relevance. Think about how price behaves over time. It moves between areas of interest, levels where decisions have previously been made. These areas might be zones where price reversed sharply, consolidated, or accelerated. They represent points of interaction between buyers and sellers, places where imbalance once existed. When price returns to these areas, it doesn't arrive empty. It carries memory. It carries expectations. Traders who missed the move before may act. Traders who were trapped may exit. Larger participants may reassess their positions. So when a candlestick pattern forms at one of these locations, it's not just a visual signal. It's a reaction within a meaningful environment. Now compare that to a pattern forming in the middle of nowhere. No prior structure, no historical significance, no clear reason for price to react there. The pattern might look clean, even convincing, but it lacks context. It's like a conversation without a subject, and without context, interpretation becomes guesswork. You've likely seen this happen. You spot a perfect-looking setup, enter the trade, and price does very little. It drifts, stalls, or reverses without explanation. The pattern didn't fail because it was wrong. It failed because it wasn't supported by location. Location acts as a filter. It helps you decide which patterns deserve attention and which ones can be ignored. Without that filter, every pattern looks like an opportunity. With it, most patterns become irrelevant. That realization simplifies your decision-making. You stop chasing every signal. You become selective. You wait for alignment, where pattern and location meet. But even then, you don't assume certainty. Because context is not just about levels. It's also about the path price took to get there. Did price approach the level with strength, or did it drift slowly? Was there momentum behind the move, or hesitation? These details matter because they shape the environment in which the pattern forms. A pattern at a strong level after a weak approach may not hold. A pattern at a moderate level after a strong move might break through. So context is layered. It's not just where price is, but how it arrived there. This adds depth to your analysis. You're no longer looking at static shapes. You're observing dynamic behavior, and that behavior often reveals more than the pattern itself. For example, A rejection candle at resistance might look bearish. But if price has been steadily climbing with strong momentum, that rejection may only be temporary. It might pause, consolidate, and continue higher. On the other hand, the same rejection candle at a level where price has repeatedly failed could signal something more meaningful. Not because of the candle alone, but because of the history surrounding it. So you begin to ask better questions. Not, is this a reversal pattern? But, does this pattern make sense here? That question forces you to consider context before action. And in doing so, you avoid many low-quality trades, because most patterns don't occur at meaningful locations.